Hi, everyone. Thank you for joining us today. As you're coming in the webinar room, I want to welcome you. My name is Marsha Butler. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation, and I have a couple of notes for our attendees. You are on mute, but we do encourage you to ask questions and make comments using the chat box. And that is a feature I need to turn on so that you can chat with us. So let me go ahead and do that right now. All right, you should be able to chat with us. The presenter will answer the queries during or after the presentation today as appropriate. And if you ask a question in the chat box, go ahead and leave your contact information as well. And if we can't get to your question during today's event, we'll make sure someone reaches out to you after today's webinar. We want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. I'd love to introduce you to our speaker today. Robbie Schoonmaker has helped individuals for over 20 years to reach their financial goals. He's worked at PricewaterhouseCoopers and Arthur Andersen as a tax and financial planning professional, helped ultra high net worth families at a multifamily office, and managed real estate for a family office for over a dozen years, in addition to helping individuals through his own practice. Robbie is a certified financial planner professional, a certified public accountant, and a registered life planner. He has a master's degree in accountancy and a bachelor's degree in history. And I know that's just a little bit about you, Robbie, but I know you're going to familiarize us with a little bit more about you and get into this topic. So I'm going to go ahead and turn the time over to you.
Thanks, Marsha. Yeah, I'll just mention a couple things about me personally. Thank you, everyone, for being here today or for watching this recording in the future. I'm in the not so large town of Pocatello, Idaho, and I really enjoy it here. I love the mountains and the hot springs in Idaho, going out and being just grounded and present and in awe out there. Really recommend everybody come here and check it out. I also have 8 kids, a lot of awe there, a little less presence and grounding sometimes, but it definitely brings a touch of crazy into life. And I would tell you that I just enjoy learning new things and experiencing new things. Love the process of getting in myself and finding out what's going on and, you know, what's keeping me from being my best self and working on shifting things to live a beautiful life. So with that, let's jump right in. And really, I would remind you as we get started, we're going to talk about a lot of details, definitions, tax, bunch of numbers stuff. But really keep in mind what the point of it is. Those are the details that lead to something. And it's what's a beautiful life for you? What makes your life meaningful? How do you use your resource to get there? So all these details just become information to help you figure out which risks and benefits you have in your decisions to lead to where you're going. So lots of details there, but we want to get back to why. Always keep that in mind. So let's start at the basics with employee stock options. What is a stock option, employee stock option? In quick terms, it's the right to purchase company stock at a given price over a certain time frame. And these are granted to employees from the company as a form of compensation and incentive. And so what you'll notice there is you've got a right to get the stock, but you actually have to do something about it to get it. And you also have to pay attention to your time frame. You've got a limited time frame. You have to take some action. So some of the terms that we're going to deal with, and I'll just explain the options as we go with these terms. So you have a grant date. So this is the date that the company sends you notice and gives you these options. You don't have the stock then. It's a promise that you can obtain stock in the future. It's contingent generally on you continuing to work there. And at this point in time, when they give you the option, there's no tax effect for you. It's not income to you then. The fair market value is what the stock is worth on the open market. So if you're in a publicly traded company, that's whatever the stock's trading for on the open market. If you're in a private company, then this is established privately. There could be a formula for your company. There could be a set time when they hire someone to do a valuation. But whatever it is, there'll have to be some function for them to know what the fair market value is for you to potentially sell at. The strike price of an option is the price that you pay to buy a stock. So they're going to grant you the options and tell you how much you have to pay to get a share of stock. That strike price doesn't change. It's consistent throughout the throughout the whole time period that you have these options, even as the fair market value changes. And the idea is that hopefully this strike price is at or will be at a price that's lower than what the fair market value is, so that you have some value in this option. So the next term is the vesting date. So when they grant stock options to normally, they grant them with different dates that they will vest. So you might get 1,000 options, but maybe 250 vest each year. And what that means is the vesting date is the date that now you're able to actually exercise the option. You can't normally do that on the first day that they grant the option to you. Again, a lot of the purpose of this is to try to get people to continue working in their jobs. So they vest over a period of time. Once that date happens, then you have a certain number of options that are available to exercise. And skipping one here, exercising is when you buy the stock. It's when you actually move from having an option to having the actual share of stock in your hand. Want to point out, as I did before, that there is an expiration date. You've got a time period, often it's 10 years or so, by which you have to exercise these options. If you don't, they expire and they just disappear. I mean, I'm aware of a situation where someone called in on the last day of expiration to exercise $1 million worth of options, but they called after the stock market had closed. They weren't able to exercise because they had expired. So pay attention to that. One more note I'd bring up with expiration is if you were to quit your job or leave that employment, the options that are already vested, you generally get to keep. The options that haven't vested, you don't get to keep, but the expiration date may change. So make sure if you end employment and you have outstanding vested options that you're paying attention to what time frame you now have to exercise, because it often becomes significantly shorter. Just depends on the company plan.
We had a question. I'm sorry,
yeah.
Before we get into this, Robbie, we had a question. What about, this is talking about stock options that you would sell on the open market. What about for privately held companies? Is that much different?
Yeah, so it's going to depend on how the company stock option plan is set up. So they may allow you, well, first, regarding the fair market value, they'll have certain times that they establish a fair market value. And as I said, they may have a built-in formula that every year they know what it's going to be, or they may set it up and leave it for a period of time because they need to hire a valuation firm. So either way, there'll be a fair market value. And then it just depends on the company's plan, whether you can exercise at any point in time after they're vested or whether they give you windows of time. Sometimes they might do that, they have a set time that they're going to value it, and then you have a set window to exercise your vested options. So it's just company specific, in short.
All right. Well, it's good to know that that's possible, but you have to know what your company's stock options are based on.
That's right. And I would say in general, there's general things that the IRS allows, but each company's plan can do things to some extent differently. So you always, if you've had options at one company and you move to another company, don't assume it's the same. They may have different rules in effect or different options, more or less.
All right, thanks. Let's go ahead and move on to this next one about the value of stock options.
Okay, great. So when we're looking at what they're worth, you're looking at a difference between what the strike price is. This is the dollar amount that you have to pay for the share, and what the fair market value is. And that's called the spread. That's where your value comes from. So in our basic example here, if the strike price is $10 and the fair market value is $25, then the spread is $15. Now, what I'd want to point out is that if the stock price doubled and went to $50, you see that the stock just went up by 100% when it doubled, but the value of your option went from $15 to $40. It went up by 167%. So why does that make a difference to you? Your options are more volatile than the stock itself. And so while one option and one share of stock, when the stock price goes up $1, the value of each of those goes up $1. But if we step back and you're looking at your portfolio and you have $100,000 worth of stock options and $100,000 worth of stock, those are different, because as that stock doubled, the options will go up more. So if you're making decisions about what to sell from your portfolio, let's say that you want to make sure you don't end up with too much company stock versus everything else you own. It makes a difference whether you're selling stock or options, not just from a tax perspective, but from the risk in your portfolio. So you'll want to pay attention to that. So we're going to talk about two major types of employment stock options today. The first one is called non-qualified stock options, and the second one is incentive stock options. And these have different tax effects. You exercise them in largely the same way, but they have different tax effects. So we're going to walk through those. Little sip of tea. Okay, so with your non-qualified stock options, NQSOs or NSOs, you might see them abbreviated. You're granted the stock and there's no tax effect there. And once they vest, there's no tax effect. Your taxes start on the day that you exercise the stock option. That's the day that you pay the price for the option and you receive the stock back. And what happens is you've got a spread on that day. If we use our example, $10 for your strike price, $25 for the fair market value, that $15 spread becomes taxable income to you. In tax terms, it's ordinary income. That means it falls into the normal tax brackets you hear about all the time, 12%, 22% when you make more, 24% above there, et cetera. It's taxed on those rates. It's also compensation, just like your salary. And as you're aware, that is then subject to a couple things. It's subject to employment taxes, the Social Security, the Medicare tax, and it's subject to withholding at the time that happens. So you will see the effect of your non-qualified stock options show up on your W-2. You'll see that income in your W-2, just like you do your salary. So now you own this share of stock and you've paid taxes to get it and paid a price to get it. And now it's just like every other share of stock that you may have. Your holding period for that stock starts on the day that you exercise and actually get the share of stock. And then it's subject to capital gains tax. You may be aware that when you sell stock or with qualified dividends, that's subject to a different tax rate system, 0%, 15%, or 20%, and potentially subject, without getting into too much detail, to another net investment income tax of 3.8% if you make enough income. So now your holding period starts the day that you exercised and got it, and you either have short-term capital gain or long-term capital gain when you sell that stock.
All right, so I would like to review really quickly what you said here, just to make sure I understand. Hopefully the audience is kind of in the same boat trying to figure that out.
It's a lot, yeah.
So the NSOs, the tax implications are that spread when you get the stock that goes on your W-2. So it affects your regular income tax.
Yep.
I guess it could also affect your tax bracket too, correct?
Yeah, that's exactly right.
Yeah.
All that income just adds up and kicks you into different tax brackets.
Okay, so that's separate than when you have the actual stock and you're selling it on the market, and then you get either capital long-term or short-term or long-term capital gains taxes on that. All right. I mean, I'm following it. Okay.
Yep.
Let's keep going. If you have any questions, just put those in the chat and I'm monitoring that.
Okay, perfect. So one more thing that's important to know here. I mean, if you start thinking about exercising, I keep saying, hey, you've got to come up with $10 to buy this stock. So if you have 10,000 options that you want to exercise and the strike price is $10, then you would have to come up with $100,000 to exercise these options. And you may have that and you may be able to do that. And that's a cash exercise. You give them the cash. Now, in the case of non-qualified stock options, as we mentioned, it's compensation. So there's also withholding. So if you're going to do a true cash exercise, you have to come up with the tax money, give it to your company so they can show it as withholding as well. That may work and you may be able to do that, but that may be a limiting factor for you. So most companies, I mean, actually all that I've seen so far allow you one type or another of cashless exercise. This is a way that you can trade some of the options that you have available that you want to exercise for the exercise price. So if you had 10,000 options, if we're looking at $10 versus 25, you may trade 40% of those options in to pay the option price. Instead of getting 10,000 shares back, you get 6,000 shares back. But then you've got to do the withholding and you get less shares back. It's that type of equation. But what it allows you to do is actually exercise the options, get the stock without coming up with cash. And this, going back, Marche, to what you're asking about private stock, and we were talking about companies have different ways to do this. This is one area that you really need to see what your options are. I've seen at least 3 different ways that you can do cashless option exercises. So see what the provision is at your company, but it's really helpful to have. Okay, so what I want to do is a little review again, walk through the time frame of when the taxes come into effect here. So with non-qualified stock options, the option is granted to you and you have no tax at that point in time. When you move on to the vesting date, when you can now exercise the option, again, you have no tax. And the reason is because you don't have the stock. It's not actually yours yet. The time that the stock becomes irrevocably yours is on the exercise date when you pay for it. That's when taxes kick in. You pay ordinary income and the employment taxes. And then you've got taxes again when you sell it. If it's in a gain position or if it's in a loss position, you don't have taxes, but in a gain position you do, and that's short or long-term capital gain and potentially net investment income tax, depending on how much income you have. Hopefully you're paying it because that means you have a lot of stock options you've just exercised.
And then you said that stock options vest at certain periods of time.
Mm-hmm.
So this might be not all of your options. It might be a quarter or a half or whatever on this timeline.
Yeah, and what happens is you might, lots of companies grant you more stock options, potentially every year. So you have stock options from 2021 that are vesting in 4 different tranches. And then 2022, they give you 4 more tranches that go over 4 different years. So you start having staggered sets that are vesting at different times. And you can choose which ones you're exercising at which time, which makes sense again to pay attention to, because if the strike price is different with different grants, you have different amount of tax effect to end up with the same number of shares. So there's a lot of analysis to look at here. Don't just assume I should do the first ones first or something like that.
And then also keep an eye on the expiration date.
Exactly, because there'll be staggered expiration dates too.
All right.
Yeah. Okay, so let's shift gears. That was the simple version. Sorry to tell you, but the IRS comes up. I mean, this is helpful to you, but it has all kinds of crazy tax effects. So let's talk about incentive stock options. We're going to get into some of it here. We're working on creating another webinar that that you might go to, you might find on the website later about incentive stock options in more detail. So watch for that, but let's dig in a little because these are a little complicated. So these have just a different tax effect. They're going to be exercised in the same way generally as non-qualified stock options. But number one, they're not subject to the employment tax provisions. So you're not having to pay the Social Security and Medicare. And also there's a way for you to avoid ordinary income tax on these and just pay long-term capital gains. That's a possibility if you hold that stock for at least a year. Now, there's some details, so let's dig into that a little bit. And if we'll just do this through the timelines with a couple different scenarios. So this looks the same as the non-qualified stock options at the beginning. The option's granted, no tax due, it vests, there's no tax due. So the difference comes when you exercise these options. Once you exercise it, remember with the non-qualified stock option, this kicks off your ordinary income and your compensation. But for the ordinary tax system, there is no tax due at the time that you exercise this, even though the share is now irrevocably yours. This is the incentive part that the IRS has allowed. And what happens then in this ordinary tax system is if you hold it for a year, then remember we got a $10 strike price, $15 fair market value is where it was. And then the stock will change, hopefully it goes up to 30 by the time you sell it. All of that income above the $10 strike price, above what you pay for it, becomes long-term capital gain that can be taxed at 0%, 15%, or 20%, rather than up to 35%, 37% in the ordinary tax system. So that's the benefit. If you exercise it, hold it for a year, and the stock has gone up, then all that spread between what you paid and where it is now becomes long-term capital gain. Now, that's called a qualifying disposition of the stock. You've qualified, and you're disposing of it, and it qualifies for the benefit. So you're not required to hold it for a year with these incentive stock options. You can also sell them whenever you want, shorter than a year. So in that situation, here's what happens. Once you hit the exercise date, again, you exercise and there's no tax happening there. It is subject to alternative minimum tax, which we're going to get to in a minute, but we're sticking with the ordinary tax system here first. Then let's say you hold the stock for less than a year. You're going to have one of three situations generally. So again, $10 is what you paid, $25 is the price when you exercised the stock. Let's say you want to sell it 2 months later because the stock doubled to 50. So what you're going to have is the difference between the strike price at 10 and the exercise price at 25. I should put my hands over here. That's ordinary income to you, but still not subject to employment tax. And then the amount above that becomes a short-term capital gain, potentially subject to net investment income tax. Now, if it's at $10 and the price goes up to 25 and it drops and you decide you're going to sell, then the ordinary income that you're subject to is just between the strike price and where you sell. They don't make you recognize ordinary income up to the $25 and then a loss. It's just ordinary income up to where you sell. And then your third option is you exercise and the price tanks, which happens sometimes, and now it's worth less than $10. And in that case, it's going to be a capital loss for you. You've actually paid $10 for that share. Now you're selling it for $8. That will be a short-term capital loss. So already that's a little bit complicated, but it's actually a little more complicated. Any questions on that so far, Marche, or should we go on to the AMT?
So what the main takeaway I'm having from this is it could be complicated. And it's not something I would want to do on my own. So that's my main takeaway here.
Yeah, it really is. And you'll see that with the alternative minimum tax too. There's a lot of potential scenarios with a lot of different tax effects. And so it's a lot of information to gather and process. And that's still the simple part. This is where it gets a lot more complicated. So the incentive stock options are subject to the alternative minimum tax. And in short, what this is an entirely separate tax system that runs parallel to the ordinary one. We'll look at the form in just a minute, but it starts with your adjusted gross income. It's just you add up all your income, and then totally different things happen within the alternative minimum tax system than happen in the ordinary tax system. And everyone is technically required to calculate their tax both ways every year, and then whichever one's higher is the one that you pay. So when you have incentive stock options, when you exercise them, there's no income for ordinary tax purposes, but there is income for the alternative minimum tax purposes. We're going to look at the form in just a second to show you where that shows up. But in short, if you end up paying more tax because of your incentive stock options, you may be able to get that money back in the future. Some items in the alternative minimum tax system create a credit that you can recapture in the future. So the idea with ISOs is if the stock price keeps going up, you will likely get that money back. And so what this ends up being is in a way, almost like a loan to the IRS. You pay them some tax this year that you'll potentially get back in the future, but you're not guaranteed to get back. So let's take a, go ahead.
So you said that if the stock price keeps going up, does that mean that you could potentially get that back? I guess I was confused. I thought that a loss would maybe mean that you get things back. Is that?
Yeah, so this is where it gets crazy. It happens differently. Why don't you go to the next slide and I'll answer that question by showing what happens on the form. So this is the form 6251. You can see there's a lot of stuff on here, and particularly part 1 is where all the adjustment items come in. So we're not going to walk through this in detail here. We'll probably do that in the other webinar a little more, but you can see on line 1, this is where it starts, and this is your adjusted gross income. It refers to the 1040, but this is just your adjusted gross income from your regular return. Now, Marche, if you go down to line 2I, I believe it is, this is the exercise of incentive stock options. So that spread amount between $10 and $25, that's where you have to put this on the form right here. It increases your taxable income for AMT purposes here. So what happens in the first year, to get to your question, is the income is higher for AMT purposes potentially. And I mean, we can't say for sure that you will then pay AMT tax. It depends on the rest of your tax situation too. But potentially it increases that income enough that you pay extra tax. And you create in the system a credit that carries forward. It's the AMT credit. Now, what happens in the next year? You're going to come and look at your taxes again and look at ordinary taxes and look at AMT taxes and see which one is higher to see which one you pay. What normally happens if your stock price goes up the next year, you're going to sell it. And when you sell it, on your ordinary taxes, you're going to have a big gain, right? Because you didn't recognize any income when you exercised this ISO, and now you're recognizing all of it. So you're going to have a big number on line 1 there for your income. But on the AMT side, remember that you already recognized income, so your basis in the stock is now $25, not $10. So if you go down to line 2K, you see that it says disposition of property, difference between AMT and regular tax. So all that capital gain, all that income that you're showing on your ordinary taxes, it's much smaller on the AMT side because you already recognized it last year. So if the stock goes up, you have a big adjustment here in line K. And therefore your AMT may be lower And now the difference between your ordinary tax and your lower AMT is the space that you can recapture that credit. And they will bring your tax down to the amount of the credit or down to the AMT amount for the year if your credit's larger than that. So here's the catch.
Oh, there's more.
To answer your question, normally I get something back if things go down. Well, if you've recognized AMT income up to the $25 range and now the stock drops down to $10 and you sell it, well, you just don't have much income on the ordinary side. You paid $10, you sold it at 11. That's a little income. But on the AMT side, you have a huge capital loss from $25 down to 11. And the issue is there's a Schedule D where you report capital gains and losses for the AMT system, just like there is for the regular system. They limit the amount of losses that you can take every year if you don't have gains to offset it. So you may have $100,000 of income last year that you paid on in the AMT system, and now your stock dropped and you sold it, and now you have an $80,000 loss, but you can't take it because they limit losses to $3,000 a year. So now you don't get that credit back. And this is another situation I've seen multiple times with folks that exercise and the stock drops, and now they have a huge AMT credit that they may not get back for literally decades. So it's something that you've got to pay attention to in the system there.
That's interesting. So that $3,000 can be every year for as many years as
it takes. Yeah.
As it takes to even that out. Interesting.
And it does, like if there's a loss there and you also have a big gain, it will offset the gain and you can use the loss that way. But if there is no gains, then the loss is limited. And so then you're not getting your credit back.
Interesting.
Because the AMT income is not that much different from the ordinary income. Yeah, so that's where it gets to the point that I can't think through this and figure it out. I have to use software. There's so many crossing systems and so many possibilities. Yeah. That's
very interesting. And I know we're going to delve into incentive stock options in that other webinar. So
yeah. Yeah, the incentive stock options, we'll walk through some examples that'll outline those different scenarios and when you need to think. So yeah, I wanted to sum up with some things to consider because again, a lot of detail there. And luckily, Advice Chaser will post this and you can watch it again and again when you can't fall asleep at night. But it's confusing information. Here's what I'd say. Here's how you bring it down to your life. Number one, I always suggest that you make decisions around this based on your life, not just on the numbers. So these options are, you might look at them as a reward for your hard work or a great gift or whatever, but they're an opportunity in some way in your life if you have all this value. And so sometimes it makes sense to make decisions based on how you're going to use it. So just to throw out an example, if you have options maybe that are worth $1 million, and you're looking at the possibility of, hey, the price could drop and that could go down fast, or it could double or triple and go up. If you have something you could do in your life with $1 million that was life-changing, like this is what gets me to retirement, and I could retire early, or I could go to part-time, or I could do what I want to do, this special trip with my dad before he passes away, whatever, it may make sense to look at the value towards your life in that way versus the future value. If that 1 million turned to 3 million, you may end up doing the same thing with it. So there's always considerations, not just on the numbers and not just the investment questions and all that, but it's who cares? What difference do these more zeros make in your life? What do you want to do with it? So I suggest we always keep that in mind when we're looking at the details. Then I'd say, consider making an investment decision around this, not just a tax decision. So particularly if we look at the ISOs, there's this tax driver to potentially save some tax money. You got to know, number one, how much. If you're paying the 15% rate plus 3.8%, that's 19% on capital gains. Maybe you're only in the 24% bracket and you're only saving 5% tax by waiting a year. Maybe you're in this 37% bracket and it's more. You want to know that, but also realize that if the stock price drops 20% while you're waiting to save 5% in taxes, you end up with less money anyway. So this whole discussion is helpful and good information, but I suggest that it not necessarily be the driver of the decision. Don't let my first boss used to always say, don't let the tax tail wag the investment dog. Taxes aren't the end all be all. Got to look at the whole situation. Two more quick things. If you're going to exercise ISOs, you may do it in a cashless way, so you don't have to come up with cash and you don't need the withholding, but you may be creating alternative minimum tax for the year. So even though you haven't sold something and created cash for yourself, you may have a big tax bill. And depending, you may be surprised how much it is. So do yourself a favor and pay attention to it prior to the exercise, because you may create serious issues for yourself where you don't have money to pay the taxes on stock that you haven't sold. So that's a downside to the ISOs. And last, I kind of alluded to this, but once you exercise those ISOs, don't assume that you have to hold them for a year. You got to pay attention to things particularly before the end of the calendar year in which you exercised them, because you can erase that huge AMT adjustment by selling them, which may make sense in certain situations, particularly if the stock has dropped. So keep those things in mind and just good luck. Understand that it's a great opportunity. There's a lot of details there, but what I wish for you is that you could understand the details enough that it just empowers you and you don't end up stressed about all of it, but you just see the opportunity in the various situations and how to move forward.
Okay, we have some time to take some questions.
Great.
So I'm going to go ahead and start with the few that have come in, and then if you have not put your question in, this is a great time to do that. Okay, here's a question. Will the company remind you when your vesting, expiration, all those kind of dates are? What kind of documentation do you get to let you know about those?
You get documentation. So when you when they give you a grant for the first time, they give you the plan document that you're subject to that has all the details in that. Every time they give you a grant, they will give you the details on all of the things I just talked about: the grant date, the vesting dates, the strike price, the expiration of all those. Generally, companies, if you're in a publicly traded company, generally, they're using E-Trade or Morgan Stanley or Fidelity or something where you've got to log in just like other accounts and you can see all those details in one place. You can exercise online, make it pretty easy. Will they remind you when they're expiring? I can't say that I know, but I would not count on it. Like, I've never heard somebody telling me that the company has reminded them that their options are expiring. So I know of one instance, as I mentioned, where apparently they didn't, or the person didn't follow through. So they do make it clear what that information is, but you just have to pay attention to it and gather it. You can find it online. I find it helpful to make my own spreadsheets sometime with all of that information in the format that makes it most digestible to me.
All right, here's another question. How long does it take to exercise an option? You talked about deadlines for like the stock market and things like that, but I'm also, can you talk about kind of the analysis that maybe your professional would want to make? So give us some timelines here.
Yeah, the professional, like how long it would take to get an analysis type of thing?
Yeah, because I'm assuming that most people are going to want to consult with someone that can really help them. Yeah. So how long does it take to exercise? Again, it's going to be company specific on what their process is, but a lot of places, you wake up in the morning, you go in, you log into your account, you click, 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 and exercise, and you're done. So it can be pretty quick. But again, check out your system, make sure you understand before the moment that you want to exercise and you realize you need to do something else before you knew, or are they, without getting into detail, you just need to look at the plan to see what their detail is to understand. Now, the analysis side, what I like to do is do this beforehand, because what happens is something will happen with your stock and it will take off. And, I may be busy that day when a client's calling wanting to know about it. So
we plan generally beforehand. Work with your professional to understand which shares would you want to exercise in what order. If you have shares, lots of times folks will have employee stock purchase plan stock and restricted stock, and they've got options that they've already exercised, and they've got options they haven't exercised, and they all have different tax effects. So you can work with your professional to understand which order would I sell or exercise, et cetera, in, so that when the day comes to do it, you're hopefully then prepared and you know without consulting them which order to go in. Sometimes if you haven't done that, then you just need to get a hold of them and see beforehand. But remember this too, all the planning is tax planning, largely. It's tax and diversification. And if the stock pops up 50% and drops tomorrow, you're better off having sold it at 50% probably than losing that, because you're only paying taxes on some kind of increase. Even with AMT, it's because there's a difference between the spread and the price. So your best bet is have that done way before you need to exercise. But if not, just go with the best information you have.
Well, thank you so much for this. Very detailed. I'm sure that people will want to rewatch some of this. And obviously, this is the start of a journey, maybe not the finish line for sure. And I want to thank everyone for being here. I want to thank Robbie and for the organizations that have made this webinar possible today. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, folks, we hope you enjoyed this webinar, and we'd love any comments as I'm closing out here. If you liked it, if it was informative, and we hope to see you at another webinar soon. Goodbye, everyone.